A couple of final decisions that business managers will have to make that we're going to cover in this chapter are: should they outsource at least a component of production, and should they sell their product as is, or should they decide to process it further? Let's start with outsourcing. Why would people outsource production? Well, there's many different reasons. One I can definitely think of is between IBM and Intel. Back in the day, Intel used to provide all of the Pentium processors for IBM's computers. IBM could have made it in-house if they wanted to, but they chose to outsource production to an expert, to Intel, in order to make the best possible product that they could. And they didn't have to waste all of their management administrative resources overseeing, training people how to make these products, etc. They had a partner, if you will, that really was good at what they did. So outsourcing, in that case, allowed them to put out a superior and differentiated product, which they could set their own price for. However, outsourcing decisions are usually a hot topic issue, and it's because they are in make or buy decisions. And the heart of it really stems from the third bullet on here. The heart of these decisions is how to best use available resources. And one of those resources is cash. Can we outsource production, save ourselves some cash, and use that leftover money elsewhere, advertising, etc.? This really came into prominence in the 90s when I was younger. Outsourcing production of textiles, vehicles, etc. really started to take off then, because it was so much cheaper to do it in parts of the world where they didn't have labor wage laws, etc. And a lot of people were angry because jobs were getting sent overseas instead of being produced here. But I understand why managers in the 90s did it. It dropped their costs significantly, and by virtue really increased their profit margins. For Smart Touch right here, we're going to have one of those make or buy decisions. They're going to decide whether they want to make the casings for their tablets in-house, or they want to outsource production to somebody else to make them for them. They know they need 2,400 casings, and per their budgeting, their expected costs for making 2,400 casings is going to be $15,600 in direct materials, $7,200 in direct labor, $13,200 in variable manufacturing overhead, and $19,200 in fixed manufacturing overhead. In total, the cost of manufacturing the 2,400 casings they need for their tablet is going to be $55,200, which breaks down to a cost of $23 per case. Let's assume now that somebody else comes through and they send them an offer and say, hey, we will make your casings for you probably at a price less than $23 a case. Well, what would management at Smart Touch have to consider here? And it's the same that we had before in prior slides, the same decision criterion. How is it going to affect our variable costs? How's it going to affect our fixed costs? Are we going to have to continue to pay them, or are we going to be able to avoid some of those fixed costs? And lastly, do we have an idea? If we outsource, we're going to have free capacity. Do we have an idea for what we're going to do with that free capacity? Let's break it down first to A or B. Do we make the casings, A, or do we outsource production of these casings, B? And we're going to do a differential analysis by figuring out what costs are unique to these two decisions that are therefore relevant to our decision-making process, and ultimately, what is the overall difference that we're going to have in the cost of casings. So if we make these casings, our information on the prior slide told us we're going to spend $15,600 in materials. We're going to spend $7,200 in labor, and we're going to spend $13,200 in variable manufacturing overhead. We're assuming, in this example right here, that our fixed costs will not change. So going back here, that $19,200 in fixed manufacturing overhead that we have right now, we're stuck with. We have people working here who are on salary, who are on contract that we're guaranteeing a job to, that we can't just let go if we decide to outsource casing. We're going to be stuck paying that $19,200 of fixed manufacturing overhead. So since we're stuck paying it, it's irrelevant. We don't even need to factor it into our calculations because we got to pay it if we make the casings or we outsource the casings. That's why it's not here. Those three our unique costs to making the casing, the cost of materials, the cost of labor, and the cost of things like electricity, maybe some depreciation if we're using units of production. They're all relevant costs, and the total of them is $36,000. Well, what costs would we have if we outsource the casings? Well, we wouldn't have to pay for materials, so that'd be big fat zero. We're not making the casings. We don't need people to make the casings for them if we're not making them in-house anymore. We don't have to pay directly for labor. We wouldn't have to run those machines, would therefore pay the electricity for them or incur the depreciation for running them. Therefore, our cost, if you will, of outsourcing the casings in terms of variable manufacturing overhead is also zero. But we have a unique cost here that is for only this alternative, outsourcing, alternative B, and not alternative A, making the casings. And that's the cost to buy them from this other party that has agreed to manufacture them for us. If that party has stated they will make our 2,400 casings at $21 a piece, that's what they're going to charge us, well then in total it would cost us $50,400 to acquire those casings if we outsource. You would think, excuse me, that buying them at $21 per case would be an easy decision when we already computed earlier that our internal cost to make them is $23 per case. But that is not what is happening here, because we have part of that cost, that $23, which wasn't relevant to our decision, that fixed manufacturing overhead of $19,200. What's relevant, what's going to be different in our analysis here is just these unique costs that we factored in. So we know now that if we make materials, if we make the casings ourselves, we're going to have to pay more, $15,600 more in materials than if we outsource. We're going to have to pay $7,200 more for labor to make them ourselves than if we outsource. We're going to have to pay $13,200 more, in this case, in variable overhead than if we outsourced. Well, that would save us a whole bunch of money, but it's offset by the fact that we're going to have to spend $50,400 to buy them. So in total, what is our difference? Our difference in this case, if we make the casings ourselves versus outsourcing, is that make them ourselves is going to cost $14,400 less. And that number is both the difference between decision alternative A and decision alternative B, and it's also the sum of the different numbers we came up with in our differential analysis. So this number in the bottom right corner should always be equal to the mathematical function that we've been doing on the side of it, A minus B, as well as the sum of all the numbers above it. Let's switch things up right now and say that we can avoid a portion of these fixed costs. Again, going back to our prior information, our fixed costs were $19,200. We can get out of a good chunk of these fixed costs. Maybe we have two people that oversee the casing production department. One of them is on contract and makes $7,200. We have to continue to pay him. The other guy, who's going to make $12,000 during this period, well, he can be let go because he's not on contract. We won't need him anymore if we're not making the casings ourselves. Well, now that $12,000 in avoidable fixed cost becomes relevant to the decision, because we only have to pay it if we keep that person on staff to make the casings. We do not have to pay it if we choose to outsource. So now we factor that in. When we add it to our direct materials, direct labor, and variable overhead that we had earlier, now our differential cost of making casings is $48,000. It's still less than our cost to buy them, to outsource production. It's $2,400 less, again, which is A minus B, and it's also the sum of the numbers above. So it's still, in this case, a better choice to make these casings than to outsource with just this information, but it's close enough that we can factor in some other ideas in here. Well, we're in the ballpark right here. There might be other things we should have to take into consideration which may affect our decision beyond just these numbers. But as a rule of thumb, don't make it more complex than it needs to be. If your cost to make the product is more than the cost to pay somebody else to make the product, well, then you should save money by outsourcing production. If your cost to make the product is less than you're going to have to pay to have someone else make it, do not outsource. And again, this is just purely by the numbers. It doesn't take into account other factors that might affect your decision. And a big one of those is, do you have an idea that you can do with that freed up capacity. So let's assume here that Smart Touch, if they outsource, now has those machines available. And they now have all of those people that were working building casings available to do something else. They can retrain employees, they can repurpose machines, and they can make a new product which they expect is going to have a profit, not just revenues, but profits, revenues minus variable expenses of $30,000. Well, that in this instance becomes relevant because it's an opportunity cost. If we choose to produce internally, we are going to give up the opportunity, because we're going to need those machines and people to make the cases. We're going to give up the opportunity to have them do something else to make this new product, which is going to make us $30,000. And therefore, since it's only for one alternative and not the other, it's relevant. It should appear in our differential analysis. So let's say Smart Touch has 3 different alternatives. They can use these facilities to make the casings. If they can't make a new product, all their machines are tied up in making casings. They don't have to pay someone else to make them for them. They can outsource. They can buy the casings from somebody else, and with the capacity they had, the facilities they were using, they can just leave them idle. Do nothing with the thing. Keep all the stuff on staff except for get out of the $12,000 of avoidable fixed costs that they had. So they can let that person go, but they're still going to continue to incur all those other fixed costs. Or, alternative C in this case, our third choice, we can outsource. We can buy the casings from someone else, which means we don't need to produce them anymore. And we can use that idle capacity that we have now to make a new product. That new product is going to generate us profit. We're going to assume here that we can still avoid $12,000 in fixed costs, whatever those fixed costs were for. I've been using an administrator, a supervisor in this case, as an example. We don't need that, so we can still get out of those $12,000 of fixed costs if we outsource and use our facilities for a new purpose. Well, now, what do our choices look like? We determined previously that to make the casings ourselves, taking into consideration all of the materials, labor, variable overhead, and avoidable fixed overhead, was going to cost us $48,000. If we outsource, it was going to cost us $50,400. So we said making the casings is a better choice than outsourcing. But now let's factor in that opportunity cost that exists here. The fact that if we outsource these casings, we have new capacity with which we can make a new product. And if that new product makes us $30,000, you can think about it this way. We could take that $30,000 from the new product that we are making, send it right to the party that we are outsourcing production to help offset the costs, and really the net cost, therefore, of acquiring those casings from someone else would be $20,400. You have to pay $20,400 more than the profit that we would receive from this new product in order to acquire those 2,400 casings, which we need for our tablets. Another choice that we have that's very similar is, do we sell or process further? There's going to be a point in production where you could sell something as is. You've built it up. It is a finished, sellable good. You can put it on the market. Or you can choose to enhance it in some way that's going to make it more desirable for your consumers. It's going to make people want to acquire it more, which therefore, again, law of demand here says we can charge more if we have something that they really want. We're going to be a price setter. So what you really need to factor in this situation is, how much extra can we charge? How much is it going to increase our revenues if we process further versus how much we could sell for right now if we sold it as is? Like between the first two bullets, what is our increased revenues? And then the second component of it is, how much is it going to cost us to take it from the way it is right now to this fancier state, which we think we can sell it for more for. For Smart Touch over here, let's say we have tablets sitting around, ready to go. We can sell them as is. Or we can choose to add some front accessible USB ports to the tablets. And we think that's something that's desirable to our customer base. And they would be willing to pay more than the, going way back in this chapter, $500 that they were paying for the base tablets. We can sell them for $500 as is, but if we spend $5 more to add those front accessible USB ports, it's going to allow us to increase our selling price by $20 up to $520. And before I even mess around with the chart right down here, this is what's pertinent on top. If somebody came to you and they said, would you be willing to spend $5 on something at a store and I will immediately turn around and buy it from you for $20, you'd be crazy to say no. Our increase in cost is way less than our increase in revenues. So therefore, if we make this decision, it's obviously got to be more profitable, and the numbers back it up. If we sold those 2,400 tablets as is at $500 a piece, we would make $1.2 million in revenue. If we sold those 2,400 tablets for $520 a piece because we added those ports, well, now our total revenue is up to $1,248,000. That is a difference of $48,000. We're going to increase our revenues by $48,000 by adding those ports. Well, how much extra is it going to cost us to put the ports in? They're $5 a piece, so for those 2,400 tablets, it's going to cost $12,000. So what we're really saying here is, should we spend $12,000 to increase our revenues by $48,000? And obviously, the answer is yes in this case, because altogether, the amount of gross profit we will have, if you will, from these particular goods is going to be $36,000 higher than if we sold as is. I didn't talk about all of the other things that went into this decision as far as getting those tablets to a sellable state in the first place, like all of the costs that we would have had to put in for materials and labor just to get the tablets to be functional, sellable tablets, even before we decided to add USB ports to the front, like those base costs that go into getting a tablet to the state that we're further enhancing from. And that's not included because it's irrelevant to this decision. If we sell as is, we're going to have to incur all of the material, labor, and overhead costs that's going to be necessary to get it to that sellable state. If we choose to process further, well, we had to get it to that first sellable state before we even chose to process it further. We have to pay for that alternative. So the $964,000 that they have right here that we're going to pay to make those 2,400 tablets is what they call a joint cost. It is shared by both decisions, and therefore it's completely irrelevant in this instance. All we care about is things that are unique to the two different decisions, and that's what our different levels of revenue is going to be and any additional costs that we have to pay to process.